We go to methods of motivation. For motivation, already we know what motivation is.
Yeah.
The willingness of workers to be happy and really want to do that job. That's motivation.
Have the potential.
Yeah, they have that. They want to do the job. They're happy doing that job.
Yeah.
Something is giving them that zeal to do the job. That is motivation. So we have two ways in motivating workers. Yeah, there are financial rewards and non-financial rewards. When we talk about financial rewards, we're talking about rewards that involve monetary payments. That is financial reward. I think that is clear.
Yes.
So different financial rewards are used there. We have wage, we have salary, we have bonus, commission, profit sharing. So we'll start with wages. So one of the financial rewards are wages. When we talk about wages, they said wages are often paid every week, sometimes in cash and sometimes into a bank account. For wages, the workers get paid on a regular basis and does not have to wait long for some money. Wages tend to be paid to manual workers, such as those who work in a warehouse or factory. Wages is different from salary. For wages, it's basically paid to workers that do not have contracts with an organization. So they get it weekly or daily. That's the point there. Okay. If the employee works longer than their normal hours, they can usually be paid overtime. This is their regular amount per hour plus an extra amount. This is an incentive to work additional hours when required by the business. So for workers that receive wages, sometimes they do more than their speculated time. Mm-hmm. As a result of that, they get paid extra. So that amount they get extra because they have done extra work is called overtime. I think that is clear. Yes. However, there are some drawbacks. As the wages are paid weekly, they have to be calculated every week, which takes time and money. So because you have to pay your workers weekly, that means every weekend, like every Fridays, every Thursdays, like here every Thursdays, you have to calculate for those workers because you have to get paid at the end of that Thursday. So that's the point there. Yes. So when calculating the wages to be paid, they can be worked out in a number of different ways. They can use time rate or piece rate. So for wages can be calculated either through time rate or piece rate. For time rate, we're talking about being paid according to the hours spent at work. So for wages, we have time rate. For wages, we have time rate or piece rate. So what's the difference between time rate and piece rate? Time rate is payment by the hour, payment for a period of time. For example, if an employee is paid $10 per hour, and they work for 40 hours, then they will be paid $400. This makes it easy to calculate the worker's wages, and the worker knows exactly how much they will be paid for working a certain period of time. For time rate, it means workers will be paid according to the hours spent at work. That is time rate. Yeah. What are the problems about using time rate? One, the hours worked are often recorded on a timesheet, which must be filled in and used to calculate the wages by the account department. This system takes time. So every now and then you need to have a timesheet for these records. That's the point there. Yes. It might take time because you have to start every time in, time out, it has to be recorded. You must not miss any of the time. Yeah. Good and bad workers get paid in the same amount of money. Here, you wouldn't measure their productivity. You only measure the time at which they work. They are at work. So you might be at work and do nothing and not be productive. You might be at work and not be productive. You will still be paid as someone who is at work and productive. So that means some workers will not do the job well and they will still get the reward for it. Do you understand? The third problem is that often supervisors are needed to make sure the workers keep working and producing a good quality product. This is also expensive. That means you have to employ a supervisor to make sure that they are working. Not like they sign in and sitting down being idle. So they need to be supervised. If not, it becomes less productive. So you have to employ someone to monitor what they do in there to be sure that they are productive. That's the problem about time rate. I think you understand time rate here. Yeah. A clocking in system is needed to determine the number of hours worked by the employee. So there's what we call the clock. Did you clock in or you clock out? Clock in, clock out. That means you need a system for that. And you have to install a system. It might be a cost for the business. Yes. Time rate is often used when it is difficult to measure the output of the worker. For example, a bus driver or a hotel receptionist. So they use it when it's more impossible to measure the effort of workers. You use time rate. Now go to piece rate. What is piece rate? Piece rate is where the workers are paid depending on the quantity of products made. So we pay you based on the output you produce. That is piece rate. I think it's clear.
Yeah.
The more they make, the more they get paid. A basic rate is usually paid with additional money paid according to how many products have been produced. Piece rate can be applied to bonus system where employees who produce more than a set target of output can be rewarded. Piece rates can only be used where it is possible to measure the performance of an individual or a team. So when you're talking about piece rate, you are being paid according to what you produce. So it is only easy for you to do that if you are able to measure the output of employees, or you are able to measure the output of the team that have done the job.
Yes.
The advantage with this system is that it encourages workers to work faster and produce more goods.
Yeah.
Because you need to produce more to get paid, to get more pay. As a result of that, you might want to do more. You might want to put more time. Like you might want to be faster getting the job done. But one of the problems about this is that workers might start looking for shortcuts, and that might reduce the quality of their output. Do you understand? They don't want to do it right because they want to meet up with time so they can get paid more. So let's see the possible limitations there. Workers may concentrate on making a large number of products and ignore quality, producing goods that may not sell very well because they are of poor quality. This usually requires a quality control system, and this is expensive. If poor quality goods are produced, this could damage the reputation of the business. So what we're saying here is this: because they are paid based on what they produce. So workers want to produce more so that they can get paid more. They might ignore producing with quality. And if they produce quality, if they produce goods that doesn't have that quality needed, business might not be able to sell. And this reduces their revenue. So what will business do to ensure that quality is part of what is being produced? They need to use quality control. Using quality control is expensive because it's another cost for the firm. So that's the first problem there. Do you get it?
Yes.
Do you understand?
Yes.
So the second one, they said, workers who are careful in their work will not earn as much as those who rush, which may not be seen as fair. Friction between employees may be caused that some will earn more than others. So another problem here is that because you need to be fast to get more pay, that means you need to be in rush. So workers that are always careful might not be as fast as those that are always in a rush. Do you get it? You are not used to being rushing. So that means you won't be able to make more.
Yes.
Do you understand? So
Yes.
that's the problem about it. The third one, if the machinery breaks down, the employees will earn less money. Because of this, workers are often paid a guaranteed minimum amount of money. So if machinery breaks down, so output will be less. So employees might not be paid according to what they've done because there's nothing to work with. Do you understand?
Yes.
So they need equipment to work with, and if there's no equipment at that time, or if there's problem with equipment, that means they might not be paid what they really deserve. So that means they have to guarantee them some minimum amount of money, which is not good for the business too. But they need to keep the workers happy. So that's about wages. I think wages is clear.
Yes.
Salaries. Salaries are paid monthly, normally straight into a bank account. They are not paid in cash. It is usual for office staff or management to be paid salaries. The salary is calculated as an amount of money per year for the job performed by the worker. It is divided into 12 monthly amounts. This means it is easy to calculate salary cost for the business. So for salaries, you are being paid a fixed amount of money at the end of the month, which calculates towards a year. That is what salary is. It's fixed. So the employer has the money in their bank accounts for longer than if they were paying their workers' wages, as salaries are paid only once in a month. So the employers, they have the money in the bank account. So at the end of each month, they just have to forward the account to be credited for certain amount of money, and that's how you get to salary. I think it's clear.
Yes.
The payment has to be calculated only once a month instead of at least 4 times a month, as with wages. For wages, you have to calculate every working week. For salary, you have to just calculate once in a month. So it saves time more than paying wages.
Yes.
Do you get it?
Yeah.
So what are the problems about salaries? One, workers may prefer to be paid weekly. Workers might need to use cash frequently. As a result, they want to get their pay weekly.
Yes.
Two, no payment for extra time worked. Workers may be reluctant to work longer. So here, there's no extra payment. It is fixed. So workers might not want to work extra time
Yeah.
or longer hour at workplace.
Yes.
We'll go to bonus. For bonus, a bonus is a lump sum paid to workers when they have worked well. It can be paid at the end of the year or at intervals during the year. Bonuses do not have to be paid. A business can decide to pay a bonus just to an individual worker who has performed well or to all of its employees if the business has exceeded certain targets. A bonus is paid in addition to the standard wage or salary. Being paid a bonus can have a positive motivating effect. Workers often consider themselves to be recognized and special if they are paid a bonus. So a bonus is a lump sum paid to workers. Why do we call it lump sum? We call it lump sum because this amount is just an additional money. So it is not expected. So it's not part of your salary or wages. But as soon as you get it, it means it's an unexpected cash that you get based on the fact that maybe you've done well or your team has done well.
Yes.
So one thing about bonus is that when you are being paid a bonus, it makes you to feel like your effort is being recognized by your employers, and that would motivate you the more. Do you understand the point? You know, it's just like, oh, I'm doing a good job, and that's why I was able to get this lump sum.
Yeah.
So that's the point there. So what are the problems about bonuses? One, bonus can become expected every year, and if they are not paid, perhaps because the business has had a poor year, then the employee disappointment can be difficult to manage. So because I have worked so well, I did that last year. I worked so well last year. I was able to get the bonus, and I'm expecting such bonus this year too. But that's my expectation to get a bonus this year, but I couldn't get it. Then I feel disappointed, and that could start demotivating me.
Yeah.
Do you understand? So that's the point there. The second one, if only one or a small number of workers are paid a bonus, then bad feelings can be caused as other workers will sense this and question why they did not receive one. So another problem is that workers can revolt. They get angry about it. Why is it that those people that are paid, why are we not paid for? Why are we not getting a bonus too?
It's a trade-off, right?
No, it's not a trade-off. Bonus.
Just because, I mean, this thing is like
Situation. No. Just see it as workers revolt. Workers, oh, you continue to get bonus and we do the same work and I couldn't get any bonus. Why am I not getting a bonus?
Yeah.
So I could get angry then, I could revolt against you.
Yes.
So there could be conflicts. That's the point there.
Maybe it's unfair.
Yeah, they might say it's unfair. So that's about bonus. I think it's clear.
Yeah.
So go to commission. For commission, these additional payments are often paid to sales staff. The more sales they make, the more money they are paid, similar to piece rate, but applying only to sales staff. This encourages sales staff to sell as many products as possible. This should be good for the business as sales may increase. Commission is paid in addition to the existing wage or salary. When we talk about commission, basically we're talking about being paid for what you produce, for what you sell.
Yeah.
Not what you produce yet. Being paid, given certain percentage on what you have sold, that is commission. Oh, if you are able to sell this house, we give you 5% of it. That is commission.
Yes.
Did you get it?
Yeah.
So it's basically for those who sell. People that sell.
Yeah.
So not salesmen. People that sell products. People that sell services.
Is it not selling?
No.
It's a different.
Sales representatives.
Okay.
A salesman is that person that is in the shop selling.
It's not, okay. Yeah, good.
Okay. I think commission is clear there. So what are the possible limitations of commission? One, if the sales staff are very persuasive and encourage people to buy goods they don't really want, then the business may see its sales increase only in the short term and then fall again as it gets a bad reputation. So if they are able to convince people to buy what they don't really want, so you persuade me to buy what I don't really want, So that would like, oh, this company continues to force us to buy things we don't really want to buy. In the short run, you might make more money, but in the long run, you might have a bad reputation.
Yeah.
Two, it can be very useful.
Because
If the sale, okay, it can be very stressful for the sales staff because if they have a bad mouth, their pay will fall. And the second problem about sales staff is that if they have a bad mouth, their sales will fall. What does it mean? It means if the cookie gets angry, they might not be able to sell to customers because they're always angry. They don't, it's difficult for them to accept everything.
Yes.
But here they have to accept whatever comes their way if they really want to sell. That's the point there. Do you get the point here?
Yeah.
The third one. There might be too much competition between sales staff to get the next customer who enters the shop. So sales staff, now there will be competition between them because the more customers they have, the more commission they will get. So now they start dragging customers. And that might be rivalry, which might not be good for the business.
Yeah, between like colleagues.
Rivalry, yeah. So that's about commission. We go to profit sharing. For profit sharing, employees receive a share of the profit in addition to their basic wage or salary. The additional payments should motivate the workers to work hard as they all receive a share of the profits earned by the business. The rest of the profit will be paid as dividends to the shareholders or retained by the business. Profit sharing is often used in the service sector where it is difficult to identify an individual employee's contribution to the increased profit, but they will all benefit from more productive work. So when I talk about profit sharing, it means all workers or all staff are able to get certain amount of money from the profit made by the business, and the rest will go for dividends for shareholders. Yeah. So it means that everyone would benefit from such monetary reward, irrespective of who you have. Because here, most of the time, businesses that use these are businesses in the service sector. In the service sector, you can't point out or figure out who spearheaded the profit of your business. Because everybody they are all working and there's no output there. It is service. So you cannot say, oh, employee A produces this, employee B produces that. No, you can't. So it is a collective work done. And that is how profit is made. So it is difficult to share profit, or it's difficult to apportion profits to just certain group of individual or to a department. All the departments work hand in hand.
Yeah.
So that is about profit sharing. So what are the limitations about profit sharing? One, if a business makes very low profit or even a loss, then no profit share will be possible, leading to employees or employee disappointment. If the business does not make profit, you shouldn't be expecting profit. You shouldn't be expecting anyone. You shouldn't be expecting share of profit because the business is not making profit.
Yeah.
Or if the business makes a low profit will not be enough to pay even dividends. So you shouldn't be expecting anything. And if the business makes a loss too, you shouldn't be expecting share of profit from them. Then, because you are not getting the share of profit, you might be demotivated as an employee. Is it clear?
Yes.
The profit share is usually calculated on the basis of an additional percentage of workers' existing wage or salary. So higher paid workers will receive a higher profit share. This could cause a feeling among low paid workers who consider that they have worked just as hard. That they have worked just as hard as those highest paid workers. When there's profit sharing is according to how your salary is being paid. So high paid workers will get high share of the profit. Low paid workers will get low share of the profit. Yes. But they'll feel like it is profit sharing. We have contributed, maybe we've even contributed more than the higher paid workers. And why are we getting less? So workers might be demotivated as a result of that. Do you get the point here?
Yes.
It is profit sharing. So some people might have the share of profit should be equal because we all contributed to the profit of the business. And the junior staff, might feel like they have done more than the senior workers that are getting more pay. So they are getting higher salary, and at the end, they are still getting higher share of profit. And we are getting low salary, and we are still getting low share of profit. So they might be demotivated. Is it clear?
Yes.
So that's about share of profit.
have fringe benefits.
So go to fringe benefits. For fringe benefits, in addition to these financial rewards, business can give other employee benefits. This usually vary according to the seniority of the job. Factory workers will get discounts on the business's products, but they would not all have a company car. Whereas a senior manager may have several non-financial rewards, such as a house, car, expense account. These are sometimes called perks or fringe benefits of a job. So when I talk about fringe benefits are benefits you receive because you are part of an organization. If you are not part of the organization, you won't receive it. So we call it perks or fringe benefits. Fringe benefits are benefits you receive as an employee based on the fact that you are part of that organization. So if you are not part of the organization, you won't be able to enjoy such benefits. That's what we call fringe benefits. Examples of fringe benefits are the use of company cars, discount for the business products, healthcare paid for, free accommodation, share option, general's expense account for food and clothing, pension paid for by the business, free trips abroad or holiday. So all these are fringe benefits. If you are not part of the organization, you won't get them.
Yeah.
That's why we call it fringe benefits. Is it clear?
Yes.